AT&T has been hammered over the last few days. It is currently at a 30-year low. We're going to take a look, understand why that is. We're going to find out if it is worth this 7.6% yield, and is it a buy now. We're going to take a look at the historical performance of the company. We're going to look at the revenues progressively over the last 5 years. Look at their balance sheet, their total debt versus total cash. We're going to take a look at that dividend safety, jump into some of their financial metrics for AT&T. And as always, we're going to run it through our stock valuation model, getting to the intrinsic value and finding out our acceptable buy price given that margin of safety. Now, before we do jump into the historical performance, what I want to do is just show why the stock is down. So it hits a 30-year low after toxic lead cable report. So the Wall Street Journal earlier in the month said that companies, including Verizon and AT&T, have left cables coated in lead from the Bell System telephone network in the US grounds, water, and on transmission poles. So they do believe litigation is coming their way, and a lot of analysts have downgraded this stock. Now, this graph, as you can see here, it shows that AT&T fell to their lowest closing price since 1993. We can see here $13.45, although the share has rebounded slightly. Now, what we want to find out is it a good opportunity for us to buy at the current prices and lock in that very nice yield? Year to date, we can see they are down 22%. They are trading right there at that 52-week low, and they do have a very large yield of 7.61%. Now, shareholders who have been holding AT&T over the last 10 years will be down 46%. Even without dividends reinvested, that is very poor. But is it something that we can take advantage of and jump in and lock in that nice yield? Now, taking a look at their revenues, typically I like to see 3 to 7% year-on-year growth. And what we can see, December 2018, $171 billion worth of revenue. December 2022, $121 billion. So there has been, in fact, a decrease over the last 5 years. However, you can attribute some of that to the Warner spin-off that did happen not too long ago. Now, what we're going to take a look at is see whether or not their net income has also decreased in line with their revenues. December 2018, $19.4 billion worth of net income. Their latest annual report, a loss of $8.5 billion. Now, it doesn't matter if they've done a spin-off. You do not expect a company to be making losses of these magnitudes. And we can see over the period, unfortunately, they have not increased that net income. We can see from December 2020 to 2021, it did increase. And then we see this massive loss. So we do need to take a look at this further in our financial metrics, just to understand that, especially if we are looking to take an investment into AT&T. Now, their cash versus their total debt. So they have $5.2 billion of cash in their December 2018 accounts. In their latest annual report, $3.7 billion. So there is that slight drop there, but it is good to see and compare that to the movement in their total debt position. Now, their total debt, we can see here, $179 billion in December 2018. And whilst it has dropped over the last 5 years, we can see their latest quarterly report showing a $10 million deduction from 2018. It is still very, very high. And as you would not be surprised, this will affect their ability to pay that dividend. Now, their dividend safety score is 70, making it safe, similar to Verizon at the same level. Market cap, $104 billion, making it a mega cap. Now, some key metrics, especially for those that believe we are headed into a recession. Now, they've had no years where they have been paying increased dividends. We'll touch upon that on the next slide. Recession dividend, they did increase their dividend during the last recession, 07 to 09, and the recession sales, whilst it was essentially flat, this was above the average growth during the last recession, which was negative. And again, even though they had negative 45% return in that recession period, it still beat the S&P's negative 55%. Now, dividend growth, as you're probably aware if you have been following the stock, there was no increase in March 2022. We can see, in fact, there was that dividend cut, and we can see the dividend growth over the last 5 years has been negative 11% year on year. And for those who have been holding that T for the last 20 years, 0% per year. Now, you may say that's flat. That is wrong. That 0% per year over 20 years is not flat. you are in fact losing your purchasing power and taking a pay cut, because the inflation rate over the last 40 years in the US was 4%. So if you're not getting at least 4%, you are losing money in relation to inflation. Now, dividend yield theory states that a company is undervalued when the current yield is sitting above the 5-year average. So we have one sign, one indicator of undervaluation. However, we never look at any model in isolation, and we'll draw our conclusions towards the end of the video. Forward PE sitting at 6, again below the forward PE average of the last 5 years, another sign of undervaluation. And the third and final sign of undervaluation is 6 in terms of the PE versus the sector PE of 16.8 for communications. Now, the 52-week price range, it is towards that 52-week low, but it doesn't mean it's undervalued at a 52-week low. Likewise, it wouldn't mean overvaluation at a 52-week high. Now, one positive with AT&T versus Verizon, if you've seen my video on Verizon, what you'll see, and we'll touch upon very shortly, is I do prefer to look at the free cash flow payout versus the earning, as the earnings is susceptible to manipulation through accounting by management, but it looks like a fairly similar story. This isn't the case. Do check my Verizon video, as they do tell different stories, which is why I always bash the story home about looking at the free cash flow payout. Now, I like to see below 60%, as that means there's room to grow that dividend. What we can see here is for the last 4 to 5 years, it has been below that 60%. Granted, in 2022, it was 64%. However, on a more positive note, that gives me some comfort over the dividend. 2023 is expected to be 41% in terms of that free cash flow payout. Likewise, I do prefer to look at the free cash flow per share. 2013, $2.53. 2022, $1.73. Now, it's not the direction you want your free cash flow per share to be heading. However, in 2023, it is expected to pick up to $2.70. But just one thing to note, you can see they have increased it from 2013 to 2021. However, 21 to 22, we did see that massive drop. And it is likely that it will pick up again, which is more positive news for those long-term AT&T shareholders. Now, we do look for steady moderate growth at 3 to 7% year on year, and you could probably justify that this isn't totally accurate due to the spin-off, which would have reduced the sales. However, for the period from 2013 to 2019, it has been for the large part between that 3 to 7% that we look for. Granted, there was that year of negative growth. Moving forwards, however, from 2022 to 23 comparison, I would like to see some increase in the sales for AT&T. 2013 total sales, 129 billion. 2022, 121 billion. Again, as I mentioned above, we can understand some reasons why, but for 2023, I would want to see that number higher than that 121 billion. So I will be interested in the annual report of AT&T for next year. Now, shares outstanding. We love it when companies return excess cash into our pockets, but we can see the opposite, where your ownership is being diluted as a shareholder, where shares are being issued. So this has been increasing, not very positive for shareholders. However, it is fairly typical in the telecoms industry, as we see with Verizon. Likewise, return on invested capital, I do like to see 10% as my pinned YouTube video, which analyzes my 7 golden dividend metrics for analyzing stocks. However, we can see here for the large part, it has been between 6 to 9% over the last 9 years. So I would like this to pick up. The only positive right now I can say is in 21 and 22, it did pick up from that 26%. And I would like to see it around 9 to 10% over the next year or two, just to give me faith in management's ability to effectively allocate that capital. Operating margin, fairly consistently over that 14% that we do look for the telecoms. Free cash flow, again, for the large part over that 7% we do look for, with an outlier in 2021. Net debt to earnings for interest, tax, depreciation, amortization, a very key metric for me in the telecoms for companies like Verizon and AT&T. Below 3.5, essentially showing that in 2022, it would take the company 3.47 years to pay off its debt net of cash on hand. Below 3.5 is what I look at. I do slightly struggle with this reaching that limit. In 2023, it is expected to be essentially very similar to 2022. So I will be looking very closely at this metric moving forwards. This net debt to capital purely showing us in 2022, 60% of the company's financing was from debt as opposed to equity. Now, if value is being provided, do hit that like button, do smash that subscribe for continued content right on your doorstep. And if you do want to grab a copy of the stock valuation model to run your own companies through, do check the pinned comment. Now, Graham's valuation, as we jump into this, we have the earnings per share at 0.8. Now, if you know AT&T, that is not the earnings per share for 2023. However, given it is negative and we are unable to use a negative in this formula, we have used the average of the last 3 years, so do bear that in mind. Growth rate expected to be very high and promising in terms of analysts and what they estimate, much higher than Verizon as previously analyzed. We have the current yield on AAA corporate bonds, and it gives an intrinsic value of $21.20, showing some significant upside to that current share price. Now, moving on to the multiples valuation model. Typically, we get companies in a similar sector and size. However, given only Verizon is probably similar for our analysis today, we will not be using it. But I can show you what we would normally do. Stock price, earnings per share, get the P multiple and times that by the earnings per share. So if we were to use it, it would have been $5.30. But as mentioned, it is not appropriate for today's analysis. Now, the average growth here we can see is slightly skewed given the fact there was that dividend cut. But moving forward, I have estimated around 2%, which is what we can see as essentially the main increases over the last 5 years. This gives a DDM price of $18.87, again showing some nice upside to that current share price. Finally, we get to the DCF model, discounted cash flow model, where we have our free cash flows. The average growth year on year at 5%, with an analyst estimating a forward-looking growth rate on the free cash flows at 3%. Using our discount rate, the present value of these future free cash flows and terminal value, we add that with the cash and cash equivalents, subtract our total debt, and arrive at our equity value. Once we divide that by the shares outstanding, a DCF price of $21 is calculated. As always, if value is being provided, do hit that like button, do subscribe for more content always arriving on your doorstep. Now, intrinsic value is essentially the average of the 3 models that we have just gone through, showing at $20, showing some significant upside to that current share price. Now, typically, wide moat, strong financial metrics, nice forward-looking guidance. I would be looking at a margin of safety of 10%. However, for AT&T, I think that is way too little. For those that would be looking at 10%, I would say an acceptable buy price at $18. For those who want a higher margin of safety at 20%, I would say around $16, $16.29, still meaning it is a buy. However, I would still think you could justify a 30% margin of safety for AT&T, and it would mean your acceptable buy price would be around $14.25, not too far off the current price, meaning that at today's price, you are getting a margin of safety of 30% based on my estimates and judgments in today's episode. Wall Street also forecast the price to be even higher than the intrinsic value, showing there is significant upside to that current share price. As always, let me know your thoughts in the comments. Are you a shareholder? Are you looking to buy? Are you looking to sell? Or are you purely on the sidelines? And don't forget to like and subscribe. Catch you on the next episode. And as always, have a lovely, lovely day.